Hello, everybody. So sorry to be the Debbie Downer today, but today and this week has been a Debbie Downer type of week, and I consider tomorrow to be the scariest day of the year. Of course, you may remember that speech last year. That speech last year was a catastrophe, and the markets dumped after that speech. And the market this week has been living in fear of the speech tomorrow, and as if he wanted to prolong the torture, like as if he wanted to make the torture even worse. The speech happens in the afternoon. If you follow me on Patreon, you may have noticed that I've bought very little stocks, very few stocks. I was happy to get MSTR on the cheap, but I bought very few stocks really the past month because I want to be a little bit cash heavy, have a little more cash, have a little dry powder available. I hate doing this short-term timing, but unfortunately this is fiat. Unfortunately, in fiat you have to take into account these short-term things that don't matter in the long run. The market has been running over the long run despite these high interest rates. Over the long run, this really doesn't matter because the cost of money, this is going to sound crazy, but even at 4.25%, the cost of fiat is like artificially low. In a natural environment, if we lived under a Bitcoin standard, the cost of debt should be much, much higher than 4.5%, probably 15 to 20% to take that counterparty risk. But we live in a fake monetary world where really it's the commercial banks who create the money. Mostly the demand for that money is going to be based on the Fed funds rate, and this is a complete mess. The fact that you have one person controlling the denominator, and sure they have a committee, but you see the dissents on the committee doesn't do much. He had 2 dissents. The most dissents in 30 years, and it still went ahead. And it looks like in September there may be 3 dissents, but it's really one person who controls the entire interest rate game. And I've seen this story. We've all seen this story over and over and over again of us expecting for a rate cut, only to see the odds as we approach the date, and in this case it's September 17 is when we should know. As we approach the rate cut date, those odds keep getting lower and lower. So the odds of a rate cut are now 73%. Yesterday they were 85%. The odds keep getting lower and lower. And note how these odds of rate cut going lower and lower is the same on all platforms. So you can see on Kalshi, 36% don't expect a rate cut. On CME FedWatch tool, which I've seen be wrong so many times, 26%. If you look on Polymarket, it's even worse. 39% of people on Polymarket expect no rate, and so and me, I just don't trust Powell. I just don't trust Powell anymore. I don't think he's ever going to change from his speech, which is saying that inflation is the bigger issue, and the typical speech that maybe the labor market, sure, but our data is showing that the labor market is strong, right? He's been saying this at every meeting. The labor market is strong. The labor market is strong because they use outdated data. They use surveys. People sometimes have multiple jobs. They count them as separate jobs in their statistics. They don't realize the same person working multiple jobs. There's so much issue with the data that they use, and of course they select the data that supports an agenda, and the agenda is one of a career agenda, is one of not being Arthur Burns, is one of being remembered legacy, like Powell wants to work on his legacy. To me, that's the agenda. And so I expect a hawkish speech yesterday. Yesterday, in my view, we're going to be saying, inflation is the bigger concern. We're concerned about inflation. And even though the data doesn't suggest much inflation at all right now, they have switched. You may have noticed over almost a year, it's been almost a year, they've switched from we're going to be data dependent, and that used to be the speech, and now the speech is Tariffs will increase inflation. That's the new speech. Tariffs will increase inflation, not realizing that really housing costs are going down throughout the country. Owner's equivalent rent, which is another made-up metric, is on its way down. They're lowering the rents. Many things are on their way down, but the narrative right now at the Fed is that tariffs will increase inflation, and now instead of being data dependent, now they are like forward-looking. And they're waiting and seeing, and they're saying we can't cut rates because tariff will raise inflation. This is a big change from before. In the past, they waited to see the data. Today, they choose to use, more liberal economic theories or Keynesian economic theories that claim that tariffs lead to inflation. But the reality, if you actually listen to these companies, we know the reality is in fact much more nuanced than that. In many cases, it's the suppliers abroad who are going to cut the costs and who are going to lay off workers and automate. And so they're going to eat some of the costs. Your suppliers in foreign countries are going to eat some of the costs. In other situations, it's the retailers in the US who are going to, erode their margins. In other times, and this is I think what's going to bear the brunt of the tariff cost is just currency manipulation and currency devaluation. A lot of countries do that, and that's how they deal with tariff. And sure, I suppose prices also may increase, but to say that all tariffs will lead to price increase is just false. It's like if you listen to the ELF call, which they make all of their stuff in China, you can see that many parts of the supply chain are going to eat some of the costs. And so my guess is that tariffs are not going to lead to insane inflation. And you're not even taking into account the fact that if a product is tariffs, there's going to be a replacement, right? Maybe someone who's buying wine, for example, is going to choose an American wine, which has no tariff. And customers shift. Customers are economic agents, just like companies. If they were to see that one of the products that they used to buy has risen in prices, are they going to keep buying that product? Or are they going to look at domestic alternative? That's why the wine example is so good in my view, because they're getting tariffs left and right from around the world, and so that means that Americans are just going to buy American wines or American beer or American whatever. You can shift, and of course, inflation doesn't take that into account. The job market is not strong, but when you use whatever survey, like who uses survey nowadays? This makes me so mad. Most elite companies don't do surveys. Like they don't even do sentiment analysis anymore. Sentiment analysis is like from 15 years ago. Who uses surveys nowadays? Well, old, outdated institutions. These are old ways of working. And sure enough, most PhDs still use surveys. This is just like the results on the surveys, on those surveys, in my view, but it's not my view. It's typical of that type of research. Is the light bulbs in the room probably explain more of the variance, right? The mood of did they take the survey in the morning or in the evening? I don't understand why you would use antique techniques of gathering data like surveys, only because it's just it probably fits their own view of the world. So I don't know. All indicators, in my view, have been saying for a long time that we should cut. But the Fed does not follow these indicators. The Fed now is all about pride, about standing your ground, and about I don't know, like rhetoric, like saying, oh yeah, you're gonna lose your job, you're gonna lose your house, because I'm keeping the rates very high, but I'm saying it in a very eloquent manner, right? That's essentially the way I view it. So the Fed is in control of the denominator, and that's how it works. And the denominator, of course, has a major impact on all investments. How many dollars are out there is the other part of the equation that is often forgotten. And unfortunately, the Fed funds rate. And I know it's not directly tied to all rates. I know there's, a lag between when the Fed acts on the overnight rate and the economy. But in general, eventually, the Fed fund rates directly or indirectly impacts all of the rates in the economy, eventually from rates that companies borrow at, rates the government borrows at, rates of real estate. That's just how it is, and it's an unelected official, a single person. Clearly, there's dissent, but that committee is not helping much, despite the dissent. It's a single person who decides that, and they have full control. And why do you have full control? You say your mandate is inflation and job market, but the data that you use is up to you. The data that you use is up to you, and so if you can pick the data, you can kind of pick your own view. So anyways. That's just the way it works. To me, the only rate of true inflation is that of money growth, and money growth has picked back up, and money growth is much higher than the 2%. Don't sleep over a 2% inflation rate. Money growth is much higher than that. CPI is a made-up concept of an average person. There is no such thing as an average person. CPI includes prices of products that the average person doesn't consume. It's like, and your own unique person may not recognize yourself at all in the basket of the CPI. There's no such thing as a stereotypical individual. So the only thing, in my view, that matters is the rate of monetary growth, money expansion. And my working hypothesis, and I'll finish with this, is that we'll get rate cuts in May 2026. That's my working hypothesis. We may get them sooner, and that would be a bonus, and I would be the first one to celebrate. But I'm not going to go into any of these events expecting a rate cut unless we are in May 2026. I'm just not, because they've done it too many times where they've said they wouldn't, where the market expected a cut and that didn't happen. So I'm not counting on any cuts. And so I think the stock market, over the medium term, say 3+ months, the stock market is always going to be fine. The stock market has gotten used to such high rates. Real estate is a different story. Real estate is struggling, in my view. And of course, people are going to be idiosyncratic and say, oh, it's not struggling in my area. But as a whole, I would say it's struggling. And when is it coming back? When is it going to make a comeback? Well, in my view, it's probably going to make a comeback sometimes in 2028-ish. And why do I say that? Because you have a very loud theory also in the Fed, which is you don't want to do 75 basis points or 100 basis points cuts because you could spook the market and trigger a crisis. And so the odds are to get back to a more normal rate, which that normal rate is zero because there's too much debt in the economy. If you want to avoid any depression, the rates need to go back to zero. And for those rates to go back to zero, well, it's going to take years, like 2.5 years, maybe 2 years, maybe, because I'm sure you can sprinkle 50 basis point cuts here and there. You can sprinkle them, but most of the time they're going to want to go at a snail pace of a 0.25 point cut, like 0.25 basis cut. And so yeah, it means it takes 4 months for you to drop by 1%. And it's actually less than that because the Fed takes a lot of time off. Like right now, there's no meeting. The Fed is taking a time off. It's on vacation in a very, very, very fancy part of the world, Jackson Hole. It's one of the fanciest spots in America. Right, good for them. But it's for us investors who care about the fundamentals. Every year in late August, we get reminded of this madness that you have like a single person who controls the denominator. And that's why I call it the scariest day of the year. You don't have to agree with me. It's just my view. I know I have a lot of macro lover and a lot of Keynesian thinkers on the channel, and that's fine. Anyways, this was not investment advice, not financial advice. This is only entertainment. Hoping you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.